Hello and welcome to Pro Trader Strategies Market Commentary for Wednesday, May the 17th. My name is Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies you can implement into your portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters, don't know what's in your portfolios, and therefore what I'm doing could be counterintuitive to what you are already doing. Having that out of the way, let's get this on. Not a whole lot of economic data today. We did get final CPI, which is basically just the final version of the flash CPI, Consumer Price Index, that we got a couple weeks ago. So that number is a little bit more important as it is a leader in a sense. This is just kind of a recap to make sure if anything had changed or when they really drilled down on those numbers, if the numbers jive. And they do. The European CPI and the core CPI both came in line with what they had previously reported. Then here in the United States, we have crude oil inventories, and it was a drawdown of 1.8 million barrels, expected to be a drawdown of 2.5 million barrels. Now, that being said, not as much of a drawdown as analysts had expected, but the market is grabbing a hold of the fact that it is the sixth straight report of drawdowns. So the market taking that and running with it. Anytime there's a opportunity to buy crude oil, the market loves to buy crude oil and push it higher, right back to the value area, or the point of control, I should say, after yesterday's sell-off, kind of breaking below that, really coming up hard against this line in the sand, which is what I've been talking about. We've got the 50-day, the 200-day moving averages converging. That's going to be a very difficult resistance area on the way back up, as with it coming into line with the point of control, which is where the most time and volume has been spent. That's where the market's comfortable. That's where the market finds value. So it could very easily just kind of stall out here, as we've seen quite a few times recently. It will be important to note whether or not we can get above that 50-day moving average and settle above there to kind of get rid of this convergence that we're seeing in the 200 in the 50-day. If they cross over, that really starts signaling more bearishness to the downside. So bulls really looking to try and get above that area. Bears are going to try and defend that resistance area. Gold futures cruising higher, up almost $20 today, pushing back into the point of control again. Big update as the broader equities are down across the board. The Dow was down almost 300 points. I think it was 280 something earlier on today. But we also have that crossover getting ready to happen in gold futures, where I'm talking about the 200-day crossing over the 50-day to the downside. So that would be a bearish sentiment if that were to happen. So anytime if we get the 50-day crossing to the upside of the 200-day, that would be bullish. But I see kind of gold kind of stalling out here for at least the foreseeable future. At least not foreseeable, but in the next few days, I think it's going to get quite comfortable there. Bonds up big today, up almost 2 points on the day, as the Dow and the broader equities are having a big down day. It's just really a flight to quality here. That is part with the crude oil cruising higher as well, up that much. The gold being up $20, bonds being up almost $2. It's really a flight to quality as people are pulling out of the equities and throwing their money into the safe havens today. On to the overall markets, as you can see here, with the Dow Jones Industrial Average almost down 250 points, getting below that 50-day moving average. That's important. Bears are going to want to try and push that down. Now, we talked about these gaps last couple of weeks. This gap has been covered not only by today, but a couple of days ago, like last, Thursday or something. And then this is the next gap that's going to be looked to cover. That could happen in the next couple of days, and that would bring us down to 20,600. So about another 150 points from where we are right now. And like I said, the low of the day was right around down 280 points, but kind of bouncing off those lows. With the Dow, or onto the NASDAQ down over 80 points, again, just off of its lows. But as you can see, this is one of the biggest down days we've seen in quite a few months, basically since back in March, I think it was, somewhere early March. But a big down day today, as we saw that E-mini S&P print those new highs yesterday, and printing the highs intraday, which was the most important thing, and I've been talking about that for a few days now too. Now that that has been achieved, it gives room for the downside, and to note that we came down and balanced right on top of that 50-day moving average, acting as support. Again, bears trying to get below that, the bulls trying to defend that, but right now E-mini S&P's down about 26 points on the day, just kind of hovering near those lows. This was the overnight session. As you can see, we kind of tanked off, got this shorter term crossover with the 200-day and the 50-day here, but that's really a 200 bar increment and a 50 bar increment. It's not really going to act as a day type thing because it's taking in these candlesticks into account. But getting that crossover to the downside today, I don't really look at this moving average as closely with the shorter duration intraday charts, which this is a 30-day intraday chart. So I don't really look at that too much here, but we are, as you can see, very close to the lows of the day, and not really being able to rebound very much since the open. Then on to a couple of things that I've done. XRT is a trade that I just put on. Retail sector continues to get pummeled, and with Lululemon 52-week lows, I think Under Armour is very close to that. Macy's continues to slide. All of these all the retail sector really getting beat up. So I decided to take advantage of some high implied volatility in here with a ETF. I usually look at anything above 30 IV percent. This had about a 48 IV percent when I initiated this strategy. I actually looked at doing a put spread on it, and not really worried about the IV percent as much, because I figured if we continue to slide, that IV is going to continue to rise as the VIX is done. Also, anytime the market goes down is when we really see IV percents kind of start to go back up. And that being the case, I thought about doing a long put spread in here, but decided to just go in with that high IV. It's kind of gotten me the ability to get outside or further away from where the market's trading. So I ended up going in and selling the June 43 calls in there for 26 cents. So looking for it to come off. If IV comes back, comes off a little bit, then that'll be good for me. So I can be directionally wrong. If this market rebounds, IV comes out of it, I'll be able to still collect premium on that. Time is my friend in this, so that's why I ended up going with the shorter duration, 30 days to expiration, try and get some of that theta decay happening as well. And then on to WYNN Resorts, ticker symbol WYNN. This had a 52-week high today, confirmation of bearishness to come. We're looking like we might want to come down, kind of cover this gap here. So I decided to put on a put spread in there, long put spread. Went into the September, so I went pretty far out and bought the 125 puts and then sold the 120 puts in there, and did it for a debit of $2.30. So slightly less than 50% the width of those strikes, so that makes that strategy better risk reward for me. If we get this market to come off to the 120s, that'll be quite nice. So it's a bit tighter of a call spread than I normally do, but this one worked out quite well with the setup, so I decided to go with that. Plus I got a long duration in order to achieve that goal. So that's about all I got for you guys today. I didn't get out of my USO yesterday, never came down to my price. I was working a 11-cent bid on my June 9.5 puts. Today, even with the market going up, I still working a 10-cent bid today, and I think it's still trading around 12, 13. So just not a whole lot coming out of those as well. So as much as it would with crude oil, probably. Anyway, that's all I got for you guys today. Friday's webinar going to be on synthetic shorts, which if we start having a bearish market here, this is going to be perfect timing for that because it's a lower margin type scenario for shorting equities in general. All right, so go to protraderstrategies.com. You need to have this one in your portfolio, especially in a bearish market, and to actually add a little bit of a hedge to your broader portfolio if it is mostly longs. All right, so I'll show you how to do this with less margin than going out there borrowing these stocks and having to pay dividends and stuff like that. It'd be a much easier way to set this up. Right, that's all I got for you. If you can't take that, take it easy.